This morning, the Bureau of Labor Statistics dropped the March inflation report. And I want to walk you through it carefully because the number itself is not the story. The story is what it confirms. Headline CPI came in at 3.3% year over year. Gasoline alone added more than half a percentage point to that number in a single month. At the same time, the University of Michigan published its Consumer Sentiment Index. Record low. Not a bad month. Not a rough quarter. An all-time record low. And the piece of that report that nobody on cable is spending enough time on right now, consumers expect inflation to hit 4.8% over the next 12 months. That expectation jumped a full percentage point in 1 month. 1 month. And the Iran ceasefire that gave markets their best week since November. Trump accused Iran this morning of doing a very poor job of reopening the Strait of Hormuz. Oil is climbing again as you watch this video. Now I want to be clear about something before we go any further. The reason I am connecting this morning's CPI report to a stock market crash in 1929 is not to scare you. It is because if you understand the sequence, today's data stops looking like noise and starts looking exactly like what it is. A confirmation of a pattern that has played out at least 3 times in 100 years. Same pattern. Same order. Same outcome every time. And right now we are deep inside stage 3 of that pattern. Here is the number I need you to hold on to. Moody's artificial intelligence recession model sits at 49%. That is 1 tick below the 50% threshold that has never once been crossed without a recession arriving within 6 to 12 months. The last time it sat this high outside an actual downturn was September 2007. You already know what came after that. And here is what makes today particularly significant. That 49% reading was calculated before this morning's CPI landed. Before the record low consumer sentiment reading hit. Before the ceasefire started cracking publicly. The pressure feeding that model has only increased since the number was published. I want to give you a framework before we get into the history, because without it the historical examples just sound like a list of bad things that happened. With the framework, you will start seeing what I see every time I look at the current data. And what I see is not random. It is a sequence. It always runs in the same order. And it always ends the same way. There are 4 stages. They always run in the same order. Stage 1 is the quiet buildup. Debt accumulates over years. Leverage builds up in corners of the financial system that regulators either cannot see or decide not to poke too hard. Asset prices go up, keep going up, go up past the point where fundamentals can support them. And here is the thing about stage 1. It feels great while you are inside it. The economy is growing. Portfolios are up. Anyone who raises a concern gets told they do not understand the new paradigm. Stage 1 can last a very long time. That is exactly why so few people recognize it while they are living inside it. Stage 2 is when the overextension becomes structural. New financial products appear that promise the upside of risky assets without the traditional downside. Regular investors pile in, usually after the professionals have been positioned for a year or 2 already. And at this point, the leverage from stage 1 is no longer optional. The whole architecture needs it. Remove it and the building collapses. Nobody wants to remove it. So everyone agrees, implicitly, not to. Stage 3 is the fracture. And it almost never starts in the middle. It starts at the edge. A regional bank nobody has heard of. A fund that closes its redemption window. A bond auction that comes in thinner than expected. Something that can credibly be called contained, isolated, a one-off. Contained is the word that gets used right before things stop being contained. Stage 3 is when emergency meetings happen on weekends, when people who are supposed to be off are sitting in conference rooms at midnight because the problem has moved from something manageable in private to something that is about to go public fast. Stage 4 is the reset. And this is the part one want you to really hear. Every historical instance of this pattern, without a single exception, involves a transfer of wealth. From the people who did not understand what was building to the people who did. From the people who were watching to the people who were not. That is not cynical. That is just how these cycles end. They always have. Now I am going to show you this pattern running 3 times across the last 100 years, because the history is not background. The history is the proof. And once you see it in 1929, and then in 1998, and then in 2008, watching what is happening right now in 2026 is going to feel very different than it did before you pressed play on this video. The setup ran for the entire 1920s. The stock market grew 600% between 1921 and 1929. The Dow went from 63 points all the way to 381. Investment trusts, which were basically leveraged funds that ordinary people could buy into without understanding what was inside them, exploded in popularity. And margin lending hit levels that in retrospect look completely insane. By the peak, investors were borrowing 90 cents on every dollar they put into stocks. Think about what that means. $1 of real money supporting $10 of total market exposure across millions of individual accounts, all at the same time. The overextension phase was the vertical run from 1925 to 1929 where the market tripled. Everybody had a stock tip. Your barber. Your neighbor. The guy shining shoes outside the exchange. And 2 weeks before it all came apart, Yale economist Irving Fisher stood in front of the Purchasing Agents Association and declared that stock prices had reached what looks like a permanently high plateau. His exact words: permanently high plateau. He predicted the market would be even higher within a few months. He said that on October 16, 1929. Black Tuesday was October 29th. On that morning, the opening bell could not be heard over the shouting on the floor. 3 million shares traded in the first 30 minutes. 16.4 million by the end of the day. $25 billion in wealth gone in a single session. That is roughly $500 billion in today's money. Now here is the part the textbooks consistently rush past. The banks did not fail on October 29th. That was stage 3. Stage 4, the real devastation, played out over the next 3 years. Between 1930 and 1933, more than 9,000 American banks collapsed. By the time it bottomed, the market had lost 90% of its value from the peak. Unemployment reached 25%. The market did not return to its pre-crash high until 1954. 25 years. And on October 25, 1929, the day after Black Thursday, President Hoover faced the press. Here is what he said: the fundamental business of the country is on a sound and prosperous basis. Sound and prosperous. Keep that phrase in the back of your mind, because you are going to hear its equivalent again before this video is done. Most people have completely forgotten September 1998, and I want to spend a minute on it because it might be the most instructive case study of all. Long-term capital management was a hedge fund run by 2 Nobel Prize-winning economists, a former Federal Reserve vice chairman, and a group of people who had literally built the modern bond market at Salomon Brothers. Not gamblers. The actual architects of the system. Their models had generated extraordinary returns for years. Underneath those returns was a leverage ratio of more than 250 to 1. $1 trillion in market positions on roughly $4 billion of real capital. A move of less than 0.5% in the wrong direction on their total book would wipe out the entire fund. When Russia defaulted on its debt in August 1998, markets moved in ways the models said were impossible. LTCM started losing hundreds of millions per day. The New York Fed concluded that an uncontrolled collapse would trigger a chain reaction through global credit markets that could not be contained. William McDonough called every major bank CEO on a Sunday. The message was not a request. 14 banks put in $3.6 billion and the crisis was papered over. Markets opened Monday like nothing happened. Here is the part worth sitting with. Every one of those 14 banks had known exactly how leveraged LTCM was. They had the quarterly reports. They funded it anyway. Because the returns were great and because everyone assumed something this sophisticated would always find a rescue. And the lesson drawn from 1998 was not that this leverage was dangerous. The lesson was that if you are big enough and connected enough, someone steps in. That logic was then applied to an entire housing market a decade later. 2008, home prices up 80% nationally between 2000 and 2007. Mortgage debt packaged globally and stamped AAA. The edge crack was 2 Bear Stearns hedge funds collapsing in the summer of 2007. Contained. 13 months later, Bear Stearns itself ran out of accessible cash in 48 hours. Not because it had no assets. Because its overnight creditors all pulled simultaneously. JP Morgan bought it at $2 a share. Those shares had traded above $170 the year before. When Lehman fell 6 months after that, $60 trillion in global wealth was destroyed over the following 18 months. The NBER officially declared the recession had begun in December 2007. They made that declaration in December 2008. 1 full year after the fact. By the time the official label arrives, you are already deep inside Stage 4. Stage 1 of the current cycle ran from roughly 2008 to 2022. The Fed held rates near zero for over a decade. That much cheap money had to go somewhere. A big portion went into private credit. After 2008, the rules on traditional banks got tighter, so the lending migrated into the shadows. Private credit funds. Non-traded business development companies. Interval funds promising retail investors institutional-grade returns. The market grew from roughly $500 billion to over $2 trillion. People were sold on stable income, limited volatility, redemption windows that would protect them. None of that was tested against everyone trying to exit at the same time. Stage 2 was the rate cycle from 2022 to 2025. The Fed raised rates at the fastest pace in 4 decades. Banks that had loaded up on long-duration treasuries during the zero-rate era watched those bonds collapse in market value. Stanford researchers calculated that if depositors ran simultaneously on the most vulnerable institutions, hundreds of banks faced potential insolvency. That paper came out before March 2023. Then Silicon Valley Bank failed. Then Signature. Then First Republic. 3 of the second, third, and fourth largest bank failures in American history, 60 days apart. Emergency programs patched the acute problem. The underlying math did not improve. And now Stage 3. January 30, 2026. Metropolitan Capital Bank and Trust in Chicago was shut down by Illinois regulators. $260 million in assets. $212 million in deposits. Routine. Contained. Reopened under new ownership within days. Watch what happened that same week. Gold and silver dropped in moves analysts described specifically as forced selling, not normal correction. Bitcoin fell approximately 8%. The New York Fed's own liquidity stress ratio was sitting at its highest level since before the pandemic. Then February 19th. Blue Owl Capital, one of the largest private credit managers on Earth with over $300 billion in assets, announced it was restricting quarterly redemptions on its retail private credit fund. $1.6 billion vehicle. Middle market lending. Sold to ordinary investors as a sophisticated income strategy. Redemption requests had hit 3 times the allowed quarterly cap. The gates came down. Blue Owl announced it would liquidate $1.4 billion and return 30% of capital within a 45-day window. 30 cents on the dollar. Economist Mohammed El-Arian publicly asked, "Is this August 2007? Is this the Bear Stearns funds?" And this morning, on top of all of that, the March CPI printed at 3.3%. Consumer sentiment just hit an all-time record low. Consumers expect 4.8% inflation over the next year. American, Delta, JetBlue, Southwest, and United are all raising baggage fees to offset fuel costs. Those increases will show up in the next CPI print. And the ceasefire that gave markets their rally this week is already cracking. Stage 3 does not stay quiet forever. Let me give you the numbers that mainstream financial coverage is consistently underweighting. Moody's AI recession model at 49%. Goldman Sachs at 30%. Pantheon at 40%. Wilmington Trust at 45%. In any normal 12-month window, the baseline probability of recession is roughly 20%. Every major institution is now well above that. And every single one of those estimates was published before this morning's CPI data landed. The S&P 500 just posted its worst quarter since 2022. The Nasdaq officially entered correction territory, down more than 12.5% from its October peak. But the index number is misleading. The average individual stock inside the Nasdaq composite is down 31%. Not the index. The average company inside it. You can have an index in correction while the market underneath it is already in a bear market. That is exactly what is happening right now. GDP grew at 0.7% annualized in the fourth quarter of 2025. Unemployment hit 4.4% in February with a net loss of 92,000 payroll positions. That is the worst monthly jobs number since 2009. And the Buffett indicator, which measures total stock market value against GDP, hit 213% as of March 2026. Warren Buffett himself has said that number approaching 200% should raise serious concern. Every time in history it has reached this level, a significant repricing followed. Now here's the part that should really concern you. The Federal Reserve's own 2026 stress test, the official worst-case scenario it is right now running 32 major banks against, projects unemployment rising to 10%, commercial real estate prices falling 39%, and house prices dropping 30%. They published those numbers themselves in February 2026. They are testing whether the banks survive exactly the trajectory the current data is pointing toward. And the Fed has no clean policy response. It cannot cut rates because 3.3% CPI with consumer expectations at 4.8% means inflation is nowhere near controlled. It cannot hike because GDP at 0.7% and recession probability at 49% means the economy cannot absorb it. Every option available has a significant downside right now. That is what a stagflation trap actually looks like from the inside. The last time the American economy was in this exact configuration, growth fading, prices climbing, central bank with no clean move available, was the 1970s. Getting out of that required interest rates above 20% and close to a decade of economic pain. And the trigger then was an oil shock. Brent crude, which started the year near $70 a barrel, is now sitting above $100. Every $10 increase in oil historically cuts GDP growth by 0.2% to 0.3% and adds 0.4% to headline inflation. Do that math on a $30 move. Before I get into the specific actions, I want to address something directly because I know what some of you are thinking right now. You are thinking this time is different. And look, in the details, every time is different. 1929 had investment trusts and margin lending. 2008 had mortgage-backed securities. 2026 has $2 trillion in private credit, AI-inflated valuations, and an oil shock from a Middle East conflict. The instruments change. The sequence does not. Prices go past fundamentals. Leverage builds in the shadows. The edge cracks first. The center follows. This time is different is almost always said at exactly the wrong moment. Some of you will say AI will fix this. Maybe. Over 20 years. But the Nasdaq fell 80% from 2000 to 2002 while the internet was genuinely transforming the economy. Technology solves problems on a long clock. Markets reprice in months. And some of you will say the dollar's reserve currency status means the rules are different here. The 1973 oil embargo produced American stagflation and a 52% market decline. 2008 originated in America and went global in 90 days. Being the reserve currency buys you time. It does not buy you an exemption from math. Now, what you actually do. If you hold any private credit vehicle, business development company, or interval fund with a quarterly redemption window, Blue All just showed you exactly what those windows look like under real stress. 30 cents on the dollar in the first wave. Find out what your exit conditions are right now before you need them. Build your cash position. 6 to 12 months of real living expenses in an FDIC-insured account or short-duration Treasury bills through Treasury Direct. Top high-yield savings accounts are paying 4% to 5% APY right now. The national average is 0.39%. On $50,000, the difference is close to $2,000 a year, and it keeps your options open when better prices appear. Watch 4 things over the next 30 days. The April 28 FOMC meeting and what Powell says about the inflation outlook. Whether oil holds above $100 as the Iran situation develops. Whether additional private credit funds gate redemptions. And the next major jobs report. If 2 or more of those move in the wrong direction simultaneously, the Moody's model almost certainly crosses 50%. And think about what has actually held value in prior stage 4 periods. Gold kept purchasing power while equities lost 90% in 1929. Short-duration treasuries and gold were the refuges in 2008. Companies with real cash flows and minimal debt. Real assets. Not the highly leveraged, not the richly valued growth names priced for a future that stagflation makes harder to reach. The data is here. Stage 3 does not send a formal announcement. It sends data. And this morning it sent a lot of it. Subscribe and hit the bell. Share this with anyone who has savings or a retirement account they are depending on. We will see you in the next update.